Well, hey everyone. Good to be back with you here. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It is Monday, July 7th, 2025. Hope you had a fantastic week. We had a wonderful time in British Columbia, getting together with my family. The Kellers all came together. We rented a house, did all sorts of fun activities. And I, as always, remind you, I make a big deal about mindful investing, about being, paying attention to what's happening in your between your ears and your head. Sort of having honest conversations with yourself and taking breaks, taking vacations, getting out and remembering why we spend so much time and energy trying to analyze the markets. I think is probably arguably the most important thing you can do. So I hope you're able to enjoy some time off last week and enjoy things. We had a lot of fun. I'm not going to turn this into a home movie presentation, but we had a ton of fun up in British Columbia, and I've heard from a number of the Canadian viewers that have said, "Welcome to Canada, enjoy," and gave me some great suggestions about what to do. Here we are with helmets and life jackets in a whitewater rafting excursion, taking a break from rafting with a picture of a waterfall that you can only see from the Kootenay River, which was just awesome. I mean, what a wonderful place, but super friendly people, wonderful food, amazing natural beauty. But awesome to also be up there for Canada Day, which I'd never seen before. That was really cool seeing how that was celebrated. And then we had 4th of July together as well. Having said that, I hope you are all doing well wherever you're at and enjoyed the week off. I hope you are happy to be back here on the show today, as I am. So let's talk about the market. So what happened last week is basically we had a classic sort of shortened holiday week experience, sort of the general playbook for a shortened holiday week. So we had Monday, Tuesday, Wednesday, then a short Thursday, no trading on Friday. General playbook is flat to slightly higher on lower volume. And that's exactly what we saw. Now, arguably, it was even stronger than expected, particularly on Thursday. That shortened holiday session is where the S&P minted a new all-time high. The volume was pretty meager, though, and we'll talk about volume in a little bit when I show you a chart of the S&P 500 with some volume readings on there. But as we see today, the biggest challenge to this market, a number of big challenges to this market, of course. I don't think it's hard to come up with what could cause the markets to go lower. But I think one of those issues that I feel like the market has been pricing in, not just glass half full, but like glass completely full, if not overflowing, is tariffs, right? Market is basically suggesting that tariffs are a non-issue. The market has been suggesting, with stocks moving to new all-time highs, with sort of offense over defense, risk assets moving higher. Market's been saying tariffs are not going to be a problem at all. Now, there's very little economic data this week. There's not a lot of earnings. That's sort of we have to wait another week until we start to accelerate into Q2 earnings season, which means this week's about tariffs. And so far, the tariff news has not been particularly great. Now, granted, the can has been kicked a little further down the road, about a month out, to give further time for deals to be made. But so far, the deals that have been announced, 100% of them have raised prices or raised tariffs from where they were before. Right, this morning, with the announcement of a 25% proposed tariff with Japan and South Korea, I don't see a scenario where tariffs are not causing prices to go up for consumers. Those additional costs to get goods from somewhere else into the United States are going to be passed on to the consumer one way or another, either directly or indirectly, either covertly or overtly. Things will cost more because of that, because the other option would be companies just eat the tariffs and don't worry about it. It's just not to be, I don't think, which means the optimism that's been baked into this market at some point has to be alleviated. I think you're seeing that today with risk assets rotating back lower, defensive sectors at the top of the list. Now, to be clear, yesterday or last Thursday, the last close was an all-time high. So let's not get too nervous about things. The trend on any time frame is still remarkably strong. However, what I've seen when the market is in a position of strength, which it is, what I see when I'm pretty much fully invested, which I basically am, I look for signs to get more defensive. I look for potential issues that could cause things to really get ugly, and I'll try to outline some of those today. Over this weekend, and actually earlier today, I did a report for my premium members, going in a lot more detail about some of these potential risks and what we would be looking for. I'll give you some highlights today as we go through the market recap. And thanks so much, Tony, for kicking things off with the super chat on YouTube. That's very kind. I appreciate it. Can't tell you how excited I am to be back doing the show. I miss it when I'm not doing it. It's a good sign you're doing something you enjoy, right? All right, let's look at the charts together, shall we? So the S&P 500 selling off for most of the day. Last hour, hour and a half, we'll call it, ended up popping a little bit higher. And we did move higher in the last 10, 15 minutes. But the damage had been done. The S&P 500 closing just below 6230. That's down about 0.8% from Thursday's shortened session. The NASDAQ down a little bit more, about 0.9%. Small caps down the most, down 1.8%. Volatility still remains relatively low. So we have the VIX still below 20. VIX is just below 18. So anything below 20 is still a low volatility environment based on my definition. However, we're sort of moving in the ugly direction here. So we gained about 1.4 VIX points today. VIX above 20, that's a red flag. You'll see me wave, suggesting that we're starting to get into a high volatility environment, or certainly volatility conditions that are very similar to previous market pullbacks. So risk assets starting things off on their heels, moving lower. Bonds sold off as well. So it's not like stocks sold off and bonds rallied. Both stocks and bonds sold off today, and rates moved a little bit higher. The 10-year yield finished today right around 4.4%. The long bond yield is just below 5%, and the 5-year point is just below 4%. So we've seen a situation where rates have generally been coming down a bit. Do we see rates start to pop up, changing a bit of the trend that we've observed? The dollar slightly higher today. I think that dollar chart is an incredibly important one to watch, because the dollar's been weakening through the course of 2025. And the way that I would think about that is just one of the conditions that have been part of this recovery story. It's the fact that the dollar's remained relatively weak. I think a bear scenario here, one of the signs that would tell you maybe things are starting to get uncomfortable. Dollar rallies, bonds rally, rates come down. That would be a concern. That would suggest basically, non-U.S. investors getting defensive and going into U.S. debt. We're not really near the point where that would start to get, probably start to be an issue. But watch that dollar chart. Spike in the dollar, particularly after it's been in a downtrend, would tell you something certainly has started to evolve. Gold remains, fairly strong here. It's sort of chopping around here around $3,200 an ounce on spot gold. The GLD basically unchanged from the end of last week. Silver slightly lower, copper lower. Crude oil prices a little bit higher. Kind of mixed results here overall, looking at the commodity space, but no significant drops. Bitcoin is an interesting one. Bitcoin currently around 108,000. I actually reached out to a friend to Market Misbehavior, Adrian Zadunchik. Adrian is an early crypto adopter, had a lot of success in the early crypto days, and grew a fantastic community, helping people navigate and learn about the cryptocurrency markets. He's now gone on to pretty amazing things in that space, and also with Web 3.0 types of things. But he is coming on my podcast later this week. I asked him to come on because he actually just announced he's pretty bearish on Bitcoin, which surprised me. So I asked him to come on the podcast and sort of explain what had changed, what his thinking was, how he see things playing out. Seasonality is a part of that, I believe. So check that out on the Market Misbehavior podcast. Well, I think I'm sitting down with him on Thursday. By the way, if you missed, the last episode was with Mike Webster. Webby is really the brains behind a lot of the coolest stuff that's come out of Investors Business Daily, and had a great interview with him right before I left on holiday. That's on my YouTube channel. Mike's awesome. He's just a humble, incredibly knowledgeable investor, loves talking about stocks and charts and all those things. We had a lot of fun talking about all things valuing stocks, analyzing charts, and some really good words of wisdom from Mike Webster. So make sure you check that out. Also on all of the podcasting platforms as well. All right, let's look at the 11 S&P sectors, what we call sector breadth, which is basically looking at the number of sectors up or down. Not great today. 10 out of the 11 S&P sectors finished in the red. Utilities, the only one in the green, slightly higher. That's one of the more defensive sectors. Consumer staples, another defensive sector, down about 0.1%. Industrials, number three, down about 1/3% from Thursday's session. On the downside, we have consumer discretionary, the XLY, down 1.3%. Tesla continuing to disappoint after Elon Musk announcing a third party he's working up. Tesla investors not appreciating that, apparently, and we're down about 1.3% for the XLY. Tesla's a big weight in that, of course, and is hurting that. The difference between an Amazon and a Tesla right about now, pretty significant. Energy, materials, both down about 1% today, as well as communication services and financials, almost identical moves, about 1% lower today. We do have earnings starting to come up, and that's where I think we'll hopefully get some clarity about a lot of these, sector bets and some of these themes, things that have done quite well. For example, insurance companies have been remarkably strong, but starting to break down. PGR actually broke below its 200-day moving average today. I forget if I grabbed that chart, but I might grab it off the market carpet here in a minute. But that's certainly an area to watch. And I hope with earnings we start to understand how they are, sort of an update on how they are seeing tariffs as a potential impact. A lot of the strategists I've talked to have suggested that maybe the impact of tariffs have not been so negative because a lot of companies sort of got ahead of things and are working through existing inventory. At some point that starts to not be the case anymore, and tariffs become more realized. We'll see, but earnings should help us sort of understand those pressures a little bit more. All right, what else can we look at on the front page here? Our market trend model remains bullish on all time frames. That's something, for me, it's more of a trend following mechanism, right? It's not predictive. It's not telling you what the trend is going to be on the different timeframes. It just defines the trends on those different timeframes with the idea that generally trends can persist. So what you do in this scenario, at least what I do, is I have a market trend model. Main one is with the S&P. It's bullish on all timeframes, which means the first thing that happens mathematically is the short-term model would have to turn, right? If there's a big sell-off, it would be enough to trigger the short-term model, but not the medium-term or long-term. So that would be an initial warning sign. And until you see that, it's noise, right? I mean, the trend overall is still healthy. So for now, as of last Thursday's close, model bullish on all timeframes. We'll check that again on Friday's close and see if there's any update. For now, it's pretty good. Brett today, not great. Brett last week was actually quite good. We didn't have a show last week. And again, apologies, but not apology. I'm not apologizing for taking a break. I hope you all do the same at some point. But I did miss, updating you on what I was seeing every day. And I will tell you that, Brett was actually pretty decent last week, right? The cumulative advanced decline lines all breaking out here in July, as I'll show you in a moment. But today, the breadth was not particularly good. And now that, once you have a shortened holiday week, sort of the initial trading after that week, when it's sort of everyone back and you sort of get, refreshed and, we see where things go. This is sort of a risk off day. And the breadth reflects that, right? The S&P 500, 4-to-1 stocks down versus up, about 81% decliners, 19% advancers. In the small cap space, over 90% of the small cap S&P 600 were down. So most things were down today. And so the breadth conditions overall, longer term breadth still okay. Short term breadth as of today, not particularly good. Looking at the Magnificent Seven and Friends, these are some leading growth names to follow. Amazon basically flat for the day. Meta basically flat for the day. Everything else down. On the bottom, you see Tesla down quite a bit. Elon Musk continuing to be in the news and mostly not in a good way. And Tesla, I mean, I honestly still a choppy chart. I don't think it's a horrible chart just yet, but it's not going up. And particularly today, down almost 7% today. Apple down as well. Apple and Alphabet. And if you talk about these charts, the three that I think we want to focus on, or at least I think are important, that are in a sort of a questionable configuration. I think charts like Amazon are still pretty good. I would say Meta, sort of testing previous all-time highs. Alphabet and Apple sort of failing to break out after a recent consolidation. Those are the three charts that stand out to me as compelling, because I think there could be a good market tell in there. Meaning, if the market's going to go up, those three names in particular probably have to look better than they are. They kind of look okay right now. They don't look great. Great is we're breaking to new highs like a Netflix and things are good. Not so great is we're unable to, right? We're testing resistance, but not trading above it. And all three of those, I would say, fit into that category right about now. All right. As a reminder, can see all the questions coming in. I see some questions on YouTube, which are awesome. Good to have you all you guys back watching live. So it looks like the normal crew as and others, and I appreciate it and welcome you all back. Please put your questions in as we go if you're watching live, and I'll try to take a question or two before the end of the episode. Anything we don't get to, we missed an all mailbag episode on the way out. We ended up having to leave a little bit early, and I wasn't able to get one out that Friday, but look forward to having an all mailbag episode Friday of this week. Have some great questions already selected, but please keep them coming, and we'll get to as many as we can through the course of this week. But let's look at what we call the market carpet. This is a heat map style visualization. Let's look at what happened today. So not a great day, right? And if you watch the show enough, the moment you bring up the market carpet, that initial reaction you have, I think has value. This is something I learned from spending years in the Fidelity chart room. When you're looking at a visualization like this, there are a number of layers of how you can experience it and how you can draw conclusions from it. The one is sort of that initial, like, what stands out, so like, what is your initial impression of the whole thing? Not getting into the nitty gritty, not picking out specific patterns or colors or stocks, but just the general vibe. And I don't know about you, but really good up days like we would have seen last week, a lot of green, kind of different shades of green, but overall you can tell most things are doing just fine. Today's kind of the opposite. This looks like much more of an unstable day. You can see some random things that closed up, and we'll get to a couple of those, but the average color kind of neutral to slightly red, I would say, right? And so I think that initial assessment is, it tells you a lot of what you need to understand about what happened in today's session. Number two, starting to look at the key, themes, key stocks, key movers, important names we want to follow on. And let's sort of go through some of these different charts. I mean, generally, as I mentioned, right, some of these names like Apple, Alphabet, Meta was flat today, but some of these names are down. And I think what concerns me is, even though we just made new highs at the end of last week, the sustained move beyond what we've seen so far, we've kind of done the easy part, I guess, for lack of a better term, which is we've recovered back to the February peak, right? We've erased that sell-off into the April low. We've regained 100%. Some stocks, of course, are a little bit further, but overall, the major benchmarks are doing pretty well. But to go even further, right, to make new highs, for the S&P and the NASDAQ to be pushing up and sustaining those gains above the February peak, you need the big names driving higher. We need the generals, moving further, because if the breadth is good, but the big names are not doing well, there's just not sustainability to the move because it's so geared toward those big names. So I think the weakness in Apple and Alphabet is very much a concern right about here. Elsewhere, in terms of those key names, we can see Tesla, as we mentioned, down quite a bit. And I think that's obviously a one to watch. It's probably the most unusual chart within the Magnificent Seven, certainly an outlier, but not strong at this particular moment. Other observations, just kind of randomly stream of consciousness looking around here. I'm struck with some of the negative moves that we see in the financial sector. Here's Progressive that I mentioned. Insurance stocks have not been great. They were great earlier this year, right? And you can see, like, in the first quarter, things like Progressive held up very, very well, while the major benchmarks were selling off. I mean, cratering. These kind of stocks held up a lot better. And as a result, the relative performance going into the April low is actually quite strong, because it was either still going up or selling off less than the overall market. But you can see from the April market low, which is kind of right about here, look how the relative performance in Progressive has been pretty negative, right? So today we're breaking below the 200-day moving average for the first time in almost 2 years. We have to go back to summer of 2023, the last time Progressive was below its 200-day moving average. It held its 200-day in January. It held its 200-day in April. It held its 200-day in June. And now July comes and we're starting to break down. I mean, the relative strength has been underwhelming for a couple months now, which means by owning Progressive, even though it's holding up, you're underperforming because other things are just going up at that particular time. But I think now breaking the 200-day is a cause for concern. So there are plenty of signs of a rotation from a bullish phase or an accumulation phase to a distribution phase, to a bearish phase. Progressive is coming up with earnings, not this week, but next week is when they're scheduled to report. That's one of those reports I'm looking forward to, just because insurance companies were so strong. They've now started to stall out, now starting to break down a bit. So Progressive stood out as an outlier on the downside today as I was looking at things. Compare that to something like Charles Schwab, which is breaking to new 52-week highs today. Schwab was one of the 10 names I picked for my Stock Charts TV show. I don't believe that's posted just yet, but keep your eye peeled on the Stock Charts TV YouTube channel. I selected one stock from each of 10 different S&P sectors, kind of highlighting an interesting idea in each sector. Good sort of educational exercise going through how we select good charts, how we can use moving averages and alerts and other things to analyze them. So I'll let you know probably by tomorrow's show. I'm sure it'll be posted and up. But also notice the big names struggling. Berkshire Hathaway kind of looks like Progressive breaking to new 3-month lows today. That's not great. Charts like JP Morgan and others have actually been remarkably strong. This is JPM making a new all-time high on Friday's session today, giving back all of Friday's gains. The problem I have with JPM and Citigroup and a lot of these names, they're all overbought. Which on its own is not necessarily a bad thing, but I'm definitely looking to see if we come back below that overbought region. That's kind of the pullback scenario that seems like a potential outcome here after the run that some of those banks have had. They've had remarkably strong months over the last 4 to 8 weeks. Other things here on the heat map to highlight. Obviously, the positive outliers, Palantir, which is a noisy stock with pretty big moves, appearing to put in a higher low with today's bounce up about a 3.5% gain. Uber making new highs today, continuing to be one of the stronger charts within the technology sector, I would argue, along with semiconductors, but it probably looks better than most of the semiconductor charts at this particular moment. Another observation to wrap up on the heat map would be the performance of defensive sectors. As I have mentioned probably many times, when conditions are good, when the charts are bullish, which generally they are, what you look for, I think, besides just confirming and following those trends as long as possible, is looking for signs that those uptrends are starting to change. And that's what I'm looking at when we talk about defensive sectors. One of those great classic signs of a potential downside rotation would be investors rotating to more defensive positioning, which means utilities, REITs, consumer staples, maybe healthcare, start to perform better on a relative basis. They start to do well when sort of the growth sectors are struggling. That can be an early indication that investors are maybe starting to lock in some of their previous gains on high-performing growth names, maybe starting to get defensive, low volatility positions to ride out a period of uncertainty. Utilities were up today as the only sector. Within consumer staples, the biggest names, Walmart, Costco, Philip Morris, having good days today. So I think keep an eye on those defensive sectors, some of those larger names and things like consumer staples, to see if they continue to do well. Could be a warning sign and maybe a reminder that being in some lower volatility, higher yielding, higher dividend paying stocks could be a good way to ride out a period of market uncertainty. All right, let's finish off looking at some charts together, shall we? And then I'll take a question or two, and then we'll be done. Looking at the S&P 500 chart, I've updated some of the key levels to watch. As an uptrend progresses, I've always felt that it's important to keep your stops updated, keep your analysis updated. I think of the daily chart of the S&P as an ongoing conversation I have with the market, sort of a dialogue, looking at upswings and downswings, thinking about key levels, reflecting on key moments so that I can refer back to those. And so we've updated this with some of these key levels. I will tell you, gaps I think could be pretty important here. And most recently, we've now had a couple gaps in the last couple weeks that I think could be pretty meaningful. We'll start back here, right? This gap in May is what I'd probably label a continuation gap. So there's different labels to the types of gaps depending on where they're at in a trend. A lot of times after a big run higher, you will have these little gaps, which are called continuation gaps, which is where you have a gap higher, and then we continue to see some upswing. Often you'll pull back, and the gap will serve as support like it did in late May, and then we resume the uptrend. So that's called a continuation gap, kind of something that happens mid-uptrend, sort of renewing and refreshing and continuing the uptrend. I would argue that this one we saw here as we gapped above 60.50, which was in late June, I think is one of those continuation gaps as well. That was after the pullback that we saw in mid-June, and then we gapped higher and then continued to trend higher into last weekend. Here's what happened though. Last week, we had this little gap going into Thursday's session. Thursday was the shortened session going into the 4th of July holiday here in the US. That could be an exhaustion gap. And an exhaustion gap is one that after you've had a really good extended run, you have one big gap up, and that ends up being the peak, right? You have that last gasp, that last gap higher. I said gasp, but I meant gap. That's a Freudian slip. We pop higher a little bit, and that's the end. And all of a sudden, no additional buyers come in. You immediately start to sell off. The gap is filled, and it can often indicate the end of an uptrend phase. And I'm, concerned that maybe what we're seeing today is quickly filling the gap that we established last Thursday. Maybe that makes that an exhaustion gap. That's eliminated if we eclipse the high from Thursday, which means we push above 6,300. This is no longer a valid take gap wise, but I would say that's something I'm keeping in mind here. Having said that, things to watch. If you watch that interview with Mike Webster, we talked about the 21-day EMA as a short-term measure of support. We talked about using that along with other moving average approaches. I'm just noticing, of course, the fact that the S&P has pulled back to the 21-day EMA a number of times off of the April low. Maybe that's an initial level of support. It's currently just below 6,100. I would say the swing low from June, certainly an important one as well. That's around 5,950. So, keeping an eye on some of those key levels, I think there's room for the S&P to pull back and make a higher low. We start to break some of those support levels. That's where it starts to feel like something a lot different. With today's drop, by the way, the RSI out of the overbought region, that may be something we look back and talk about down the road. So keep an eye on the chart of the S&P as always. Advanced decline data overall has been good. You can see some of the data is in these ones here pulling back have been updated. These ones haven't been updated yet for today's session, but you can see that the New York Stock Exchange AD line generally has been in an uptrend and made a new all-time high on Thursday's session. So when the AD lines are breaking out, that tells you conditions are pretty good. We have a bit of a pullback probably in all of these breadth readings today. However, they're all still above an upward sloping 50-day moving average. In my opinion, that tells you the breadth is still pretty strong here. More days like today make those charts look less good. For now, it's pretty strong still. Let's talk about volume a little bit. Volume last week was pretty light, and that's not surprising, right? If you sort of think about the normal, holiday week playbook, lighter volume, flat to slightly higher is what you generally see. It's exactly what we saw last week. The real question is when everyone kind of gets back at their desk and starts trading for real again today. And this is where we're starting to see more distribution. So we saw the trend in volume was lighter through the course of this week. Here's today's volume, a little heavier on a down day. The shaken money flow continues to trend lower, even as the S&P is making new highs. When I think from a technical perspective, that is one of those risks that seems pretty clear to me. The market drifting higher on weaker and weaker momentum just doesn't tell you there's a lot of, force behind this uptrend. It's more sort of dribbling higher as opposed to driving higher. Sentiment data last week was pretty interesting. I shared this with my premium members at Market Misbehavior, but just to get you all circled in, this is from last Thursday. This is the weekly data you get from NAME, the National Association of Active Investment Managers. There's a group of money managers that every week share what their exposure is to equities, what their allocation is. It can be up to 200%, down to negative 100% on a fully short. To last week's reading came in just below 100%. I've drawn this horizontal line to show the previous times when this level has been, when we've been at this current level. December 2024, beginning of July, 4th of July weekend a year ago, March of 2024, December of 2023. Here's the bad news. That's this point right here, just going into the early peak in 2025. That's here just before the July peak in 24. That's here just before the peak in early April of 24. And here before, granted, a brief pullback going into the end of 2023. So when this survey gets over 100%, that's when I start to look for a contrarian pullback because the respondents in the survey are super bullish. And often you can get a contrarian down move, something to keep an eye on as I pick that up today. Chart of the dollar, I think, could be pretty key. Right now, you can see the dollar index, which is $USD on the stock charts platform. On other platforms, it's known as DXY. So just look for a US dollar index, something that's weighted versus different currency cross rates. And you can see that the dollar index bouncing higher over the last week. and moving higher today. Still below all the moving averages. All the moving averages are sloping lower. You can see the momentum has been classic bullish, classic bearish range. Sort of the whole range of the RSI has moved lower on these little bounces higher. The RSI is not getting above 40, which is above 60, which is pretty consistent for a downtrend phase. The last couple bounces have gotten right up to the 50-day moving average, and that's it. So I would look to see if we get a change there. And if you do see a spike in the dollar, at the very least, that tells you something is different, right? We've had a weaker dollar through the course of 2025. Any change in this chart, I don't read as a particularly good sign. A lot of that is going to be what it actually, reflects in terms of investor behavior. That's something we'll have to understand more if it actually plays out. Talk about the chart of Bitcoin. Again, I'm excited to interview Adrian Zadunchik. He's a great crypto expert, someone I've interviewed before. I've always appreciated his perspective. We can see the chart of Bitcoin has just stalled out. I mean, this is what we call a power on stall, a big uptrend, and then we're just kind of holding water, right? And I would say 110,000 has essentially been the peak. We drifted a little above that in May. We drifted a little above that in June. We've now, basically hit right at that level in July, and it failed to get above there. So while it's not a bad chart, right? This is not a broken chart just yet. It's certainly not going up anymore. This is a meh. This is a neutral rating, right? If I'm rating charts based purely on the technicals, the momentum is almost dead neutral, which tells you that up days and down days are pretty even. So, generally this is sort of a question mark chart. I think it's a great chart if you power above 112,000 on stronger momentum, but it's not what we're doing just yet. So for now, stalling out, not bad, but not great anymore. Offense versus defense. This is one of those classic charts I like to look at to think about whether investors are rotating to more offensive or defensive positioning. Note that the cap-weighted version using the XLY and the XLP, sort of well below its May peak. The equal-weighted version using the RSPD and RSPS for those two consumer sectors has broken out. The reason why there's a difference right now is because Tesla's a big weight in the XLY. It's going down pretty big. As a result, it's weighing on the numerator of this ratio pretty good. The equal weighted version doesn't have that much of an overweight in Tesla. As a result, it's actually breaking out. And this one in the bottom is the one I think is a better reflection, I guess, of investor rotation. So for now, it's telling you conditions are positive. A rotation lower would be an issue there for sure. All right, let's talk about a couple of the Mag 7 stocks. I'll take a question or two. We'll call it an evening. Meta, number one. I want to see this breaking above 740. I want to see it clear that late June high, which would also clear the February peak. Meta has basically round tripped from the February peak down to the April low, all the way back up to that same starting point around 740, but it stalled out and has not gotten above there. I think a bull case from here for stocks has to involve Meta, avoiding a double top pattern and breaking to new highs. Has not happened yet. The momentum has actually been trending lower. It's a bearish divergence at this point. Alphabet, chart number 2, has stalled out at Fibonacci resistance. It's right around $180. You can see here, based on the February high and the April low. We found resistance at basically each of these Fibonacci points, and now we are stalling out, which means this is an exceptionally good chart if and only if we get above 182 and hold it. It's stalled out and has been unable to do so. So Alphabet also just not breaking out when you really want to see it do so. Apple is the third one. We basically tested resistance at 215. It's pretty much where the peak was in mid-May and in late April, not far from where we were here in mid-April. And it's also a 50% retracement of that Q1 rotation down to the April low. You want to see Apple get above 215. And so we have three key stocks, Meta, Alphabet, and Apple. All three have tested resistance. All three have failed to get above there. For me, that means these charts are questionable in terms of their upside potential unless they can get above those previous peaks. I think those are key charts to watch right about now. All right. Let's take a question or two, and we'll call it an evening. Dave, thank you so much for watching on Facebook. You said, do you use your methodology for stocks the same on ETFs? I've learned so much from you. You rock. Thanks, man. I appreciate that. I do rock at times, I hope. I try to encourage my kids that Dad rocks. The methodology the same. I mean, so a lot of it, right? I think that's one of the great benefits. And I remember when, honestly, like early 2000s, when I was just getting started in the industry, and I remember talking with a money manager just about ETFs. While ETFs were not as widely spread, besides like the major ones, there weren't all the hundreds, if not thousands, of ETFs that you see today for every little granular thing. It was more the high level indexes and sectors and things like that. And those are the liquid ones that you could use. But there was just such a great benefit in analyzing a group of stocks like a stock, right? I mean, so you could analyze the energy sector or the material sector just like you would analyze Microsoft or Apple or Pets.com or any of those names from that era. And so I think the great benefit of ETFs is that they are liquid, they're widely traded, and you literally can think of them as stocks. So I would say a lot of the methodology that I use very, very similar. There are some differences, though. I would say from a technical perspective, very, very similar, right? Stocks and ETFs look very similar as long as the ETF or the stock is liquid enough, meaning as long as there's enough volume. With some ETFs, they're just not traded enough. There's just not enough assets under management. They're not as actively traded. As a result, the chart is not going to be as effective because a chart is only as good as the data that supports it. So I would say that's one thing to keep in mind with any of those charts. But overall, as long as it's a liquid thing, I think yes, analyzing them in a very similar way, the technical toolkit is almost identical. I would say the non-technical stuff is where things get different. With individual stocks, we have things like earnings risk, sector risk. You can think not just about the stock, but the group, and then the sector, and then the overall market. And thinking about that relationship can be a meaningful way of understanding a stock's movements. So reflecting on the sector that it's in and what that means, I think is sort of unique to that. On the ETF side, I think you want to dig a lot more into as part of your due diligence, the fees involved, right? Management fees, things like that. The spreads. So ETFs that are less traded, the spreads are a lot wider than you'd think. And so just buying it, you're basically have to get a certain percentage gain just to recover your entry costs for getting things started. And that's sort of an ETF issue for the most part. It doesn't happen a lot in except for like pink sheet stocks and really small names. Also the bets. I think what's helpful with ETFs is going deeper and understanding the stocks that it holds. I find a lot of times with ETFs, people are not super clear on what exposure they're getting. To understand that, I use a tool called Koifin. So you bring up like the XLY, and then you look at the holdings, and so we can see. Oh, hold on. Of course, it busts as I try to do it. Hold on. Here we go. There we go. So I'm looking at the XLY, the Consumer Discretionary ETF. This, of course, is almost 100% ETF. It's probably just like a little bit of cash or something in there, which is unclassified. But a diverse ETF, you can see what sector and what industry bets are most significant, which can be helpful. But you also see how top heavy it is, right? So the top 10 holdings make up about 69% of the ETF's weight. Amazon on its own is 23% of the XLY. Tesla is 16%. Home Depot is about 7%. So between those three names, you basically have almost 50% of the ETF or just those three stocks. So I think with ETFs, you have to do a little deeper. I found a lot of times people just buy an ETF based on the name of it. So like an infrastructure ETF, right? Like PAVE, I think it's super valuable to look at what stocks are actually being held in there. And then you'll see like when the chart looks really good, you go, oh, well, it's an aerospace company. It's the number one bet here. That's the biggest bet that it's making. Is it more of an equal weighted ETF, or is it really top heavy and concentrated on the biggest names? Those are things I think you need to do a little different with ETFs, not something you have to worry about with stocks. There's other things you have to worry about with stocks, but those are some of the ways that I would think of them a little bit differently. But overall, yeah, from a technical perspective, I think that's one of the great benefits of using technical analysis is that, you can actually use the same toolkit across different asset classes, and it's pretty helpful. Folks, that'll do it for today. I can't thank you enough. It's so fun to be back. I appreciate your kind words. I appreciate all of my Canadian viewers that had very nice words when I put out on social media and on my YouTube community that I was heading up there. Boy, what a beautiful country and just warm and lovely people. We absolutely loved it. We put a Canadian flag. We got one on Canada Day. We put it on the dashboard of our car. We've been driving around with it all week. I just had lunch with my family. and we still have it there. I don't know if we're going to take it off for a while because it just brings back a lot of happy thoughts for us. But for now, I will say thank you so much. Thanks for watching this show. Thanks for watching. Thanks for supporting me and Market Misbehavior. Have a wonderful evening. And remember, it's always a good time to own good charts. Have a good night, folks.